thanks very much for coming in. Good turnout today. A lot more people are supposed to come in, but I guess they will be making it in their own time. Uwe Jacobs, property strategist from Property Friends. Can you do me a favor? If you look at the bottom of your screen, you should have a button that says chat. If you click on that button, a little chat window will open. And if you can just give me a thumbs up and okay or something that you can see the presentation, little known steps to accomplishing your property investment. This. That would be fantastic. Casey Ziga, thank you very much. That's excellent. Thanks very much for your feedback. Hello, Joel, is it? I think. How are you?
Good, thank you. Thanks
Excellent.
for the invite.
Thank you. Thanks for coming in. Can I ask you for a favor? Would you mind muting yourself during the presentation? Excellent. Thank you very much. I was just saying we've got a chat window. If you have any questions during the presentations, please put them in there. We have an extensive Q&A session at the end, and I'll promise to answer any questions that there are, even if it takes 10 o'clock. Just kidding. Okay, so we've established that you can see the presentation window. Let's kick it off. That's good. Okay, yeah, here we go. A bit of housekeeping. Please understand that this is a virtual session, so technology doesn't always behave. Camera, if we can leave it off and put ourselves on mute until we get to the Q&A session. I will, provided that I remember and that gets too carried away, also invite for questions in between. Any questions are welcome. Put them in the chat window. We are happy to email the recorded webinar to you so that you don't have to take too many notes, but readers are leaders and writers get the most out of the information that is presented. That's what I generally find. Last but not least, thank you for joining in. Your interest is very much appreciated. I know we're all busy. I'll do my darndest to provide you with the best that I have. All right, this is the make me do it part. This information provided is general in nature and does not take into account your specific circumstances. The usual nonsense, not nonsense, the usual legal overrider. Please talk to your own advisors and do your own due diligence. Obviously, in a general webinar, I can't talk about your specific circumstances. I've been doing this for over 20 years and have been a property investor for over 20 years. I will only talk about what my wife and what I are prepared to do ourselves or have done. So everything that I'll talk about is from experience, and in our business we have a very simple principle, and we have some existing clients on the call. They will be able to vouch for that. We only are suggesting what we are prepared to do ourselves. So you can already tell by my accent that I'm not originally from Germany, that I'm not. When I get excited, I talk gibberish. So forgive me for that. That just proves the point. I'm Australian, or English is not my mother tongue, originally from Germany. Some 35 years ago, I came to Australia, and I think it's one of the best countries to live in. Okay, that also means that I am usually very direct. I don't mean to step on anybody's toes, but I generally say what I think, and at the very least, you always know what I'm up to. Okay, tonight's agenda. I, in the invite, highlighted 3 things that I really wanted to cover, and that is why to utilize assets and cash flow. A lot of people have assets and cash flow and don't do anything with it. To me, that's a crying shame. How to optimize your investment. Again, some 20 years ago, 23 years ago, when Ulla and I, and my wife and I started with investment properties, I found that a lot of people were taken for a ride, were taken advantage of by scrupulous vendors, by builders, and by even some buyer's advocates or agents. And quite frankly, I got sick of that. So we decided to do something about it. There are many ways to invest and even more ways to optimize. So that's one of the big points that I want to cover. And what to do to accelerate the results. Then the next steps, of course, is why do it all and what to do next. Is that making sense to everybody? Give me a thumbs up, okay, or this is all BS, or whatever, please. In the chat window, that would be fantastic. There's Joel, thanks for the thumbs up. Excellent. I can tell that you are a versed Zoom user. Okay, just a couple of Sieger. Yeah, yes, in German. Yes, oh, I like that. You're getting very much my bosom friend. All right, just a couple of things on who are we, what have we done, where have we come from. We provide solutions for people aspiring to financial independence, that want choices in retirement, or that want to leave a legacy. We've been in business for 20 years, so been around the block a few times, have learned a few things, have brushed our knees a couple of times, got up and did it better next time. 76% of our business is return clients. I'm really, really proud of that. That not only means that our system is working, that also means that we're doing a good job and an honest job. And that means that people are trusting us to return, and it means that we have a sustainable system. Our 7-step success system provides accurate, unbiased investment guidance, training and opportunity, and we mitigate risk. We go for full disclosure. We charge our fee for service completely separate to the deal. That's a decision that we made 20 years ago, because I think it's a hell of a conflict of interest, and this is where I get very direct, forgive me. I think it's a hell of a conflict of interest when you get paid by the vendors. Ultimately, in my view, you may beg to differ, we serve the person that pays us. And we want to have our allegiance, our alliance, our service provided to the purchaser, to our clients. Hence, we charge our fee for service completely separate to the deal. The big advantage about that is I can look any one of you in the eye and say, you pay the same that I pay. Again, our mantra is only if it's good enough for Ulla and myself, it's good enough for the team. Check out our client feedback, testimonials. We've got many video testimonials and written testimonials on our website. You can't do what we're doing for 20 years and have no bad marks against you without doing a good job. And I'm proud of it, and I admit that. Okay, so let's get into it. I want to keep it short and sharp so that we can get most out of it and get to the crunchy part, which is the Q&A. So why utilize asset and cash flow? Well, 86% of people end up dead. Dead tired, dead broke, or just dead when they go into retirement age of 65, 67. Now, I guess we can all agree that that's not a very highly desirable circumstance. So, not in good options, are there? The point, though, is what do you want to achieve? Now, if you don't want to end up where the 86% of people end up, we need to do something else. Doesn't that make sense? And needing to do something else starts with establishing a baseline. So we need to effectively do what is in business called a profit and loss. I can throw plenty of big words around. I can also make it very easy. I like to make it easy. So it is simply, what is my income and what is my expenses? What do I get as salary, wages, or as business income? And what are my invoices that I have to pay every month? Be that rent, be that mortgage, be that food, be that whatever. At the end of the day, hopefully there is a positive result. When I add all my income up, take all my expenses off that, hopefully there's something left over. If not, we've got a big problem already. And it's better to know it than running blind. We also need to know our, what is in business called balance sheet. Let's make it easy. What do we own and what do we owe? So, do we have a car? Do we have a car loan against it? Do we have a house? Do we have a mortgage against it? Or do we have an unencumbered house, principal place of residence, with no mortgage against it? Again, we can take what we own, offset what we owe, and hopefully there's something left over. That would be our net worth. If not, we've got a bigger problem. And it's even better to know it now than in 20 years. And the third item to establishing the baseline really is cash flow. What do our monthly expenses, invoices, bills look like versus our income? There will be ups and downs. As long as at the end of the year, again, there is a positive difference, we're good. If there is a negative difference, it's better to know now than in 20 years. This sounds simple, I know, and I'll make a bit of fun of it, I know. But it is the very fundamentals. It's the basement that we build our house on. Do not underestimate the importance of that, please. Now, my suggestion to you is that 86% of people don't have this set up. And that means they're flying blind. And when I fly blind, I can't go very far. In fact, I hit a roadblock very quickly or run into something. Now, the other point to the equation is, what's the end goal? We need to know where we want to go. Do you want to be at age 65, 67, one of the ones that is dead tired because you're still working, or dead broke because you're living on the pension? I don't know about you, but I didn't. So that's why I got up and did something different. And yes, hey, let me not qualm about it. There is some work involved. As far as I'm concerned, and here comes my direct German way again, there is no free lunch. There is no get rich quick scheme. There is a lose of lot of money quick scheme, but not a get rich quick scheme. So there is some work involved. But what's the end goal? What do you want to do? See, all we are doing is developing a specific plan with a specific intent, and we develop a customized multi-property strategy. Now, I'll cover more on that, but really, that's what it's all about. And at the end of the presentation, I'll offer you a free discovery call where we can have a look at all of these things. Where are you at? Where do you want to go? And what would be the start of a strategy to get there? I'm happy to offer that for 30 minutes for free because you've taken the time to get on this call, and we can start looking into that. So let me also say one other thing. Most people come to us because they either want to be financially independent, or they want to have choices in retirement, or they want to leave a legacy. You don't do that with one investment property. And that is one of the reasons why we develop a multi-property strategy. That is one of the indicators what we are doing well in Property Friends with this 76% returning clients. We have many clients that have been with us for over 10 years and many clients that have been working hard and enjoying the fruits of their labor too, with over 10 properties. But I'll cover on that a bit more later on. And see, what if there was a system where you can set up multiple properties as investment, and the investment carries itself completely, so that you don't have any impact on your lifestyle? What if we could facilitate that? Ask yourself that question. If you can set up an investment that is relatively low in risk and that pays for itself completely, but can have massive upside. Because one thing I don't believe in, and that I say up front straight away, and that is big negative gears. Yes, we take the non-cash deductions to create tax deductions, but there is a seesaw effect between capital growth and rental income. And if you go too much in either way, you are not getting to the optimum result. I'll come to that later on. So that's the reason for the multi-property strategy. Okay, let's get into it. Utilize your assets and cash flow. I realize that this is a very complex model, and you're only seeing one part of it. And I know it's very detailed. All it is supposed to show you that in good circumstances, you can take the equity that you have available, and through asset growth in the property, every time when you've got enough money to buy another one, end up after 10 years with 13 properties and $1.3 million worth of equity. Now that's a model. I'm very proud to say that we've done that with 3 families. The fastest one was in 3 years and 6 months. Now, they had their time hanging out, circumstances were good, and they started with a lot of equity. All agreed. I'm not saying that everybody will do this. I'm not saying that everybody can do this. I'm not saying that it is for everybody to do this, but I'm saying it is very possible. We've proven it 3 times already. And the proof is in the pudding. Here's just 2 examples. I've changed the names. This family made $309,000 in equity gain in 3 years. This is a family that had more equity available. As you can see, they started off with 3 properties in the beginning, but after 3 years, they ended up with $602,000. Now, of course, that all depends. And this is, again, the full disclosure. I'm going to give it to you as it is. Depends on where the market is in the cycle, in the property cycle. The optimum time to buy is when we are just at the beginning of a rising market. Now, anybody that can promise you and give you a guarantee that they can forecast that, I think is a liar. Yes, there are many indicators that can spell that out and can give good indications for it. But I've seen markets that were indicating beautiful capital growth fall apart within 6 months. And that in itself is why it's so important to have, again, balance between rental income, why it's so important to have the property paying for itself. And as Warren Buffett said, return off my money is more important than return on my money. So in the first instance, we want to make sure that we can't lose stacks of money. That's why we research our markets that we move in very carefully and to the best of our ability and knowledge, only select markets that are fairly safe. Of course, timing of the market can advantage you. In an ideal situation, we all want to buy when the market is just starting to rise. Clear. However, time in the market is more important than timing the market. Ultimately, the best time to buy property was 10 years ago. The second best time is today. Because the more time you can spend in the market, essentially time heals all wounds, even if you buy at the worst possible time. Now, we don't want to do that, obviously. And I'd like to think that we know what we're doing, and I won't put you in a deal that we don't think is a good deal. Anyway, how to optimize? Well, the first question is, do I look at property investment as a hobby or as a business? Now, again, I don't want to step on anybody's feet, but hobbies cost money, businesses make money. Look at property investment as a business. Now, as such, delegate, don't abrogate. So, yes, outsource, have specialists do what they do best. But to the best of your knowledge and ability, make sure that you keep the overview. This is something that we pride ourselves in. We have champion team meetings, and the next one is coming up, where we educate, train, and share freely knowledge with our team, with the people that are working through their investments with Property Friends. Ultimately, I want to get the knowledge up in the team, because the more knowledge we have, the better deals we can do. Very simple. Then there is our 7-step success system. That is a system that has been developed over 18 years and gets continuously checked and continuously improved. So again, I'm not a fly-by-nighter. We've been doing it for a long time, and the continuous improvement process is what makes our system so good. And that system creates a predictable and repeatable risk mitigated outcome. And I come back to it. If we can get to an investment that pays for itself, has good upside, and is risk mitigated, I reckon that's pretty darn good. But you be the guest. Now, the question then is, how do we accelerate? I have a number of times alluded to balance and growth. I really want to spend more time on that, and I will after this slide. Minimum 5, better year, 10 years property strategy. This is not an overnight success. Property investment is a fairly stable investment, but also ramps up and compounds over time. Best is to look at 3 or more properties, because that creates the results, the changes in being financially independent, in having choices in retirement, or in leaving a legacy. We don't do that with one property. So hence, the suggestion is to straight away look at a multi-property strategy. And the hardest thing is not property number 1. The hardest thing is property number 5 or 10. Now, if we look at that straight away and gear ourselves for that, that's the best thing to do. Of course, we all start off with number 1, but why not look at it with the end in mind? And that is, again, a question that we very much bring out up front. What's the end result that you're looking for? And hey, I only make suggestions. You are the boss. We do what you want to achieve, because that's the only way that it can work as far as I'm concerned. Risk versus reward. That's why I love property investment. The risk is fairly low for the big rewards that can be had. What is the right strategy for you? Well, very much that depends. It depends on your profit and loss, on your balance sheet, cash flow, on your goal. So what is your income versus your expenses? What is your the things that you own versus how much liability, how much do you owe, how does your cash flow look like, what's your goal? All of these things influence what is the right strategy. So I think you can see already there is no one fits all. And that's why we call ourselves property strategists. I don't flog property. I want to sit, ideally, the fun part is to sit with people and to develop a personalized strategy. How do I get where I want to go? That's fun. That's what we're good at. Okay, I'll get on my hobby horse, sorry. Everyone is different. It makes sense, doesn't it? That's why we offer a 30 minutes discovery call. Lenny, if I can get you to paste the link into the chat that people can copy it. Thanks, Lenny. So feel free to book into that. That's only the beginning of the discussions, of course, but that will be enough, quite frankly, for you and us to work out whether we can work together, whether we can trust each other, and whether we want to take it any further. And to me, that's the way it should be. You know, we don't want to cause ourselves problems. We want to cause ourselves solutions. Okay, I've very much alluded to the balance between rental yield and capital growth. That is one of the most misunderstood points in property investing, in my view. I've also alluded to the fact that I don't believe in big negative gearing. Let me explain why. So, high rental yield, or what is rental yield? The rental yield, the rental income is the short-term money. I call it short-term money because we get weekly, fortnightly, or monthly our rent as a property investor. So that's money that ticks in periodically. This money creates our lifestyle. It creates the cash flow, as opposed to capital gain, which comes at the end of the period, whether we revalue or whether we sell. So this is the cash flow that comes in every month, every week, or every fortnight. Now, that cash flow, as far as I'm concerned, in our books needs to be high enough, the income needs to be high enough, the rental needs to be high enough that it carries the property completely. Because then, and then only, does it not have an influence on our lifestyle. The things that I don't want to do is, as we have seen in Sydney, for 7 years, Sydney was lying flat. Now, as with many big cities, capital cities, the rental income in the capital cities is shot between 2.5% to generally 4.5%, which means that you pay money towards a property investment. Yes, you get a tax deduction for that loss, but 32 cents on a dollar or even 40 cents on a dollar is not the reason to do a deal. If you want to do that sort of deal, give me any amount that you want to give me 100,000, I'll give you 32,000 back. And everybody says, that's stupid. Well, that's negative gearing. You can set it up so that you still can take advantage of the tax deductions, but that the property breaks even. So that's when it does not interfere with your lifestyle. I don't want to be in a situation, as I was saying in Sydney, where I pay $500 of my after-tax money into a property investment, do that for 7 years. And I don't know whether your partner would say something or not, but my partner, my wife, had certainly said something. After 6 years, she asked me the question, why would you do that? And I said, there's going to be capital growth. And the wife said, I want to go on holiday. I haven't been on holiday. See, this is why lifestyle is so important. Our subconscious kills you off if you have too much negative gear. So what did people do? They sold. And promptly, year 7, 8, 9, the Sydney market went up 70%. But who knows when it happens? And I, for one part, don't want to have a $500 negative gear, $500 that I need to take out of my after-tax income and put it to the property. And even if you can do it, with one, let me ask you a question. Can you do it with two? Can you do it with three? With four or five? Because that's what it takes to make a change. That's what it takes to be financially independent. That's what it takes to have choices in retirement. That's what it takes to be able to leave a legacy. So cash flow and lifestyle is important. Financing, if you have a high negative gear, you'll get stuck with the banks. And we've just seen the interest rate go up 25 basis points or 0.25%. There's no question that it will continue to go up further. I reckon we'll sit at around 2.5% by the end of the year. So financing costs are going to go up. And this is again why cash flow, why rental income is going to be so important. So, but it is the small money. It is the money that keeps us ticking over. Now, let's look at capital growth. Capital growth is the long-term money. It's the increase in value that the property experiences. Two ways we can do that. We can have an immediate uplift, which I call better buying or wholesale buying, where we buy a property at less than its market value. That's nice. That's the immediate kick up the ladder. And of course, there's capital growth that happens over the continued timeline, the normal increase in property value. Usually that takes a number of years. The capital growth will also give you lifestyle in regards to when a property, say, over 10 years, say, has doubled, you can sell it and retire the debt and have plenty of money left over. So that's how long-term we create lifestyle. Refinancing and building the portfolio can only come out of capital growth, traditionally. Because even if I have $200 a week in positive cash flow due to rental income, that's $10,000 a year. That's good money, but you need to wait 10 years to revalue the property or to get your bank to give you another loan. That ain't gonna cut it. However, if let's say, $500,000 property increases by 10% in a year, and that is $50,000, after 2 years, you can refinance that and have the deposit for the next one. I'm not saying that every property will do 10% every year. I'm just highlighting the possibilities here. Now, capital gain is the big money. As I was saying, $200 a week is $10,000 a year in cash flow from a rental. Only 1 year at 10% on a $500,000 property is $50,000. It's easy to see why this is the big money. So why do we need both? We need both because the personalized strategy will develop which way is the optimum for you. Can you take a little bit more on the capital growth side and to have a bit of give on the rental yield side? There are also there is the old seesaw effect. Invariably, when one is high, the other one is low. So when we've got very high rental income, as for example in mining towns, traditionally they're not only very fickle, but there is very little growth, stable growth. However, if you go for very high capital growth, there's very little rental income. So that's why the balance is so important. Ideally, in our world, you want to have the situation that the property pays for itself completely, and that's the rental income. And then you go for the maximum capital growth that you can find. Now, there are investment phases, 3 investment phases. One is the asset building phase. The second one, and we call that the accumulation phase. Then there is the consolidation phase. That's where you just sit when you've hit your target, where you just sit and let the properties grow. And then there is the repatriation phase, where you retire debt and where you then sell properties to retire debt and to be cash flow positive, or sell the whole portfolio and then live off the funds that you've created. So 3 phases: accumulation, consolidation, and repatriation. I can hold a whole seminar about why the one that goes through the fastest accumulation phase wins. If you think back about the example that I brought about the family that had 300,000 and the family that had 600,000 in 3 years, the 600,000 started off with 3 properties. They had good equity to start off with, and they were able to build their portfolio very fast. That makes the difference. So take it as given, whoever can accumulate fastest wins, in a sustainable way, that is. So let me give you a case study. This is not BS. This is, in fact, the house that you see on the screen, Tasmania, Midway Point. 4 years ago, we started there. And yes, we pride ourselves in selecting 3 to 5 markets in Australia and pick what we can humanly find with our experience, with our tools, with our systems, as a great area to invest. We purchased this in, well, we helped a client to purchase this in 2018 for 360,000. Have a look at those views. That is the experience that we bring to the table. I can tell pretty much before any other buildings are there, what is the best block. That's experience. That's what 20 years of experience buys you. And we were fairly certain that we would have good water views from that location. We've done 5 properties in that estate. That was really good. So bought at 360, anticipated rent was 390. You can see that's 5.6%. That was certainly paying for itself. What's today's value? 550 to 600,000 easily. Let's be conservative. I'm always conservative. 550, let's say. That's $190,000 in 4 years. A lot of people don't make that in income. The annual rent, the actual rent, sorry, is now 530. We're actually getting 550 for the last one. That's a rental yield of 7.1%. See, I don't need to go into crazy investments or high risk investments to create good rental yields. If you give it enough time, or if you have good uplift in capital gains, you invariably also have uplift in rental yield. And that's what the system is about. Now, what stops me from taking this 190,000, going to the bank and doing a redraw, revaluation, taking 80% of the 190,000, I can buy 2 more properties with it. And this is exactly what these guys have done. They're just about to complete their next property. Now, that didn't go as good as this one. It only has, on completion, $50,000 worth of capital gain, only, and looking at it, about 6% worth of rental yield, only. The system works. There's no question about it. And yes, I don't mind admitting there are ups and downs. There is the property cycle, but the system works. And for example, we have one family on the call. They've been with us for a long time. Beautiful example. There was an area that came up very good, retracted a little bit, and is now going through the roof again. Property investment is a game where we have to invest time. As I said, minimum 5, better 10, better 15, better 20 years. The hare wins the race. Sorry, the turtle. No, what am I saying? The turtle wins the race, not the hare. Okay, so allow me to play you a little testimonial from some guys that have done properties with us.
G'day, I'm Dion and this is my wife Jacinta. We've just recently completed our very first home with Property Friends. That house is in Townsville. We've gone and inspected it and seen everything that's come together over the period of time during the build. We're very, very happy. With all the advice that we've been able to get through Property Friends, we've certainly had the encouragement and the confidence to pursue our investment path and tackle another one, which will be in another state, which will be ready very soon. Through Property Friends, we've been able to access information, advice sharing, and a whole network of people that's been invaluable to the confidence that we need to get our property portfolio started. Thanks.
These guys are going great guns, and I'm really proud, and I'm happy to have done a bit to them changing their financial situations. They've got 3 kids. They have secured their lifestyle and certainly secured the future. And that's fun to me. Anyway, the why. It's all about you. If you haven't worked that one out, let me say it quite clearly. We only suggest the biggest thing that I can do, that we can do for you, is help you to work out 3 things. Where are you at? Where do you want to go? And then only can we establish what's the best way for it to get there. As a bonus 4th point, that if you book into a discovery session, I'll release that one to you. Get the information, do your due diligence, get with the right team. The old adage, it's hard to soar like an eagle when you're surrounded by turkeys. Where are you at? What's the end goal? And then we develop a customized multi-property strategy. Yes, we all start with number 1. Maybe you already have number 1. That's fine. Book a discovery call and we'll have a look at where we're at. Okay, I have rabbited on for too long already, 3/4 of an hour nearly. Let's get to some Q&A. Feel free to open the cameras, open the microphones. Lenny, do we have any questions that came through the chat?
Yes, we have a couple.
Yeah.
The first one is, why are you so strong on balance?
Okay. Very simple, because in my books, it's the only sustainable way to build up a life as an investor without having to forgo my lifestyle, and the only sustainable way how I can build a portfolio. By going for something that pays for itself and then looking for the biggest upside that I can find, I'm mitigating risk. I'm going with the Warren Buffett methodology, and nobody can argue that this guy doesn't know what he's doing, that the return off my money is more important than the return on my money. I want to make sure that we don't lose big amounts of money and that we can live the same lifestyle that we've lived before the investment and be safe. And then look at the biggest upside. I hope that makes it clear. If not, whoever asked the question, get more into it.
So we have another one. Can you help us with financing then?
Okay. I was saying before, it's hard to soar like an eagle when you're surrounded by turkeys. I've been in property investment for 20 years, but I'm not a finance person. The short answer is I can't, but what we do in Property Friends is we do wholesale buying power. We do sets of 5 or 10 properties. That means we've got buying power. It stands to reason that as a group, we are stronger. So we have, over the years, created strategic relationships with companies, with partners that are experts in what they are doing. Now, this is not two-tier. I'm not getting a cent out of it. No brown paper envelopes. I'm not getting a cent out of any referrals that I make. But what these guys are doing, they are pre-qualified experts in their field. So I can refer you to mortgage brokers. In fact, I know every one of us has got specific areas of expertise. I know whether the specific mortgage broker is better in self-managed superannuation fund deals, or better in first investment property deals, or better in 10th property investment financing. So we have a whole team of specialists around us that makes this game a lot more fun. Because one of the hardest things when I started, maybe you're different, when I started, was to answer the question, who is a good accountant? How do I judge a specialist with specialized knowledge when I don't have that knowledge? The best way that I found is ask around in the circles of advisors or friends that I had and have, and say, what's the best person for that job or task? Now, if we can put on top of that the group leverage, so think about it. If I'm a mortgage broker, if I'm a rental manager, whatever, and I get approached by Uwe Jacobs for one property, is that going to be a different picture than when I get approached by Property Friends and I get asked, we will do 5 to 10 properties in the next 6 to 12 months in this area for this purpose? Would you like to be the strategic alliance partner for our team in this set of properties? The builders are licking their chops. Everybody is advantaged in a group deal. That's why we get special service, special rights. And again, I don't get a cent out of that. That's a hot button of mine. That's where we can add value to the team. Sorry, I got carried away. Feel free to open the microphone and ask direct questions if you want to. Anything else, Lenny?
So if you don't get any kickback, sorry, why refer?
Very simple. We decided when we started this business that we have one fixed fee. That way it makes no difference to me whether I sell, whether the property value is 500,000 or 5 million. The fee is fixed. For that fixed fee, we do the whole job. And if I can help other people with services that I myself need. See, my wife and I are in the game ourselves. We need the mortgage broker. We need the rental manager. We need the building inspector. We need the conveyancer or legal eagle. All the services that you need is what we need. We win by being part of the team. We get the better service, the cheaper prices by being part of the team. And that is fine with me. And I don't mind admitting I like big deals better than small deals. So we win by being part of the team, by being able to leverage from the team. And ultimately, this is one of the points of difference with Property Friends. We get paid once per deal. But again, people on the call have been with us for many, many years, and they'll be able to vouch. Have a look at the testimonials. There's one couple that has been with us for 13 years. I was last week in Cairns and Townsville. I sent them photos of their properties in both cities. Did I get anything for it? No. I'm interested. I love what I do. So if I can help people with bettering our situation, their situation, the group's situation, I reckon that's fun.
We have last one question.
Yeah.
Can you increase return, specialized duplex, NDIS, or increase capital gain?
Great question. That comes from an advanced investor or from somebody who has really thought about it. The short answer is yes. Typically, the only way to do that is one, with specialized knowledge, or two, with higher risk, or three, with a combination of one or two. Again, not beating around the bush. Specialized knowledge, you have seen that this deal here, where is it? No. The case study, here we go. A $190,000 capital gain in 4 years and a 7.1% rental yield is nothing to be sneezed at. With specialized knowledge and with specialized experience, we can optimize situations. Now, that's again a matter of a very personal discussion. If I talk about a duplex, I'm automatically talking upwards of $700,000. Not everybody can do that. Most of our properties are around the $500,000, $550,000 mark. I want to keep it affordable. I want to keep it in the median. And that's where the most amount of buyers or sellers are. Hence, that's where the risk is lowest. But you can certainly get advanced returns and advanced capital gains by having the experience, by doing enough research, and by being honest and genuine. Now, let me say something about that. And again, I want to be very blunt and very clear about it. Nobody can guarantee this. And the guys that guarantee anything have got huge margins in it for themselves. And I would ask myself, why do I get a rental guarantee or anything like that? And who pays for that? And by the way, what's the company that stands behind that guarantee? Different subject. So suffice to say, there are specialized investment channels that can be taken that increase your return, but that's a matter of a personal discussion. Does that make sense? Come on, guys. I bet there is a question or two from the floor. It's 7:55. I don't want to go past 8 o'clock, but I want to give everybody a chance to ask some questions. Or was there anything more, Lenny?
All good.
All good. So here's your chance. Any questions from the floor other than what we had already? No? Okay. All right, then I would like to make you a special offer. A great resource is a book that only took me 5 years to write. The 7 Secrets of Highly Successful Property Investors. For the next 24 hours, you can use the code ebook for success and purchase the PDF version for $10. Lenny, if I can get you to see, this is why I love working with great people. There's the link in the chat window. Copy the link. You can get it for $10 for the next 24 hours. Other than that, book a strategy call. Let's have a chat. I trust you got something valuable out of this. If you have any further questions, feel free to book a discovery call, and we will send out the recording tomorrow. And of course, we'll give you the chance to go on our updated news list. If at any point in time you want to unsubscribe from that, by all means do. Rest assured, your data will never be sold or anything like that. I just find that people are better decision makers when they're better informed. So we publish information regularly. I'd like to think good information, so it's very worthwhile to be on the distribution list, but that's for you to decide. We'll pop your name and details on the sharing, and you can unsubscribe at any given point in time. But do take me up on the strategy call. It's 30 minutes free for you. So what have you got to lose? On that note, thank you very much. Thanks for listening to me, and trust you got some good nuggets out of this. Thank you, Ziga. Okay, take care. All the best. Bye-bye.